If you're self-employed in Alberta and you've ever been told, come back when you have 2 years of good history, I have good news for you. That is not the full story. In fact, you can make great money and still get treated like you make nothing. Not because you're broke, but because lenders are reading your income like a broken GPS. I can take two self-employed people, same industry, same revenue, same lifestyle, and one gets approved for $650,000 while the other only gets approved for $250,000. And I know it sounds crazy. It is crazy, but your approval actually has nothing to do with how much money you make. It all comes down to this one section in your taxes that most people don't even know exists. And once you see it later in this video, you'll understand exactly why lenders are misreading your income. By the way, my name is Ushindi Mutabazi. I'm a mortgage associate here in Alberta, and I specialize in helping self-employed Albertans like yourself qualify for a mortgage without waiting 2 years for income averages, paying more in taxes, or changing the way you run your business. In this video, I'm gonna walk you through the exact step-by-step process to getting a mortgage in Alberta as a self-employed borrower. Make sure you pay close attention though, because step number 4 is where most people accidentally sabotage their approval before they even apply. I am also going to show you why two people can run the same business in the same industry and make the same money and get two totally different approvals. If you're self-employed and are planning to get a mortgage in Alberta, this video is for you. You could be a sole proprietor, incorporated, a contractor, commission-based, it does not matter. This video is for you. Before we get too deep though, the first thing you need to understand is that lenders don't approve based on how hard you worked. They approve what you can prove. You can be the hardest working person on earth, and you can have a busy business, you can have income coming in daily, but if there's no proof or paper trail, you're gonna have a very difficult time getting approved for your mortgage. Most lenders do not care that you made $150K in revenue. What they care about is a taxable income that says $60K, and that number is what they built their entire mortgage off of. Now that you understand that part, let's walk through the exact step-by-step process that will ensure you get approved for the highest amount you qualify for. Step number 1 is to figure out what lane you're in. There are two different self-employed realities. In lane A, your taxes show strong income. You don't write off aggressively, and your net income on paper is healthy. In this lane, you qualify more normally. In lane B though, you write off a lot, which is smart for taxes, but now your net income on paper is low. That means you need a different strategy. Being in lane B does not mean you're doing anything wrong. In fact, lane B usually just means you have a great accountant working for you. I personally believe one of the most beneficial things about being self-employed is the ability to maximize on the tax benefits. But that being said, you can't pretend the bank is going to ignore all of the deductions. Your income is stating that it's low. If you're in lane A, you can walk into most banks and they'll be happy to help you. But if you're in lane B, it's a little bit more complex. The lane you're in determines your whole mortgage journey. Understanding this part is important because this is where most people mess up. They try to force themselves into a lane A approval process even though they're clearly in lane B and write off a lot. That's like me trying to charge my iPhone with my Dell laptop charger. Nothing is broken. The charger works, my iPhone works. They're just not meant for each other. But the good news is later in this video, I'm gonna go through the exact next steps for each lane so you don't end up making the same mistakes that other people are making. Step number 2 is knowing your documents. This is the step that ruins most people's files. Some of you think mortgage documents are like a buffet. Not you, of course, you know better, but the other person watching this, they 100% look at it like a buffet. They think you can just show up and say, you know what, lender, here's what I have, pick what you want and take it. Lenders don't necessarily work like that. It's more like airport security. If you show up with the wrong ID or you're missing one document, you're not kind of getting let through. You're just not getting through at all. And the order matters as well. They check the ID first, then the boarding pass, then the bags. Same thing with mortgages. Lenders have specific pages they want in a specific order because those pages connect to how they calculate income and assess the risk. Sorry for the interruption, but this video is sponsored by myself. If you're self-employed and looking to buy a home in the next 12 months in Alberta, make sure to click the first link in the description and complete my 3-minute mortgage readiness quiz. Once you complete that quiz, I will personally record you a custom video within 24 hours breaking down your real numbers, exactly how a lender would view your file, and laying down a clear approval strategy based on your timeline and your goals. Also, make sure to follow me on Instagram at @Ushindi for more self-employed mortgage advice, or just to chat, or if you have any questions, a link for that will be in the description as well. Let's get back to the video. If you're a sole proprietor, you have 2 core documents that you need to make sure you have. Number 1 is your T1 General plus the notice of the assessment. That's your personal tax return and CRA's receipt that they assessed it. If you do not have those, honestly, don't even bother wasting your time. Number 2 is your T2125. This is your business activities page inside of your personal taxes. This page shows your gross business income, expenses, and your net business income. Most self-employed people have never even looked at their T2125. That one page can explain exactly why you're not getting approved for the amount that you're looking for. If you're incorporated though, this is where things kind of get interesting. You might say, my company made $200K last year. Sure, but how much did you make? When I come home from a soccer game and my fiance asks if I scored, if I say, oh yeah, we won 5-1, that's cool and all, but that's not the question. Did you score? How much did you make? Anyways, with corporations, lenders usually look at 2 things. Number 1 is, once again, your T1 plus your notice of assessment, because you are the person qualifying, not the business. Number 2 is proof of how you pay yourself. Is it salary? Is it dividend? Is it a mix? And depending on the lender and your setup, you may need corporate financial statements, a corporate T4, a corporate notice of assessment, and sometimes a letter from your accountant confirming ownership and income strategy. Here's the part I don't want you to miss though. It's very important. If you pay yourself a low salary or low dividends to reduce your personal taxes, that makes your personal income look low on paper. Even if your corporation is healthy, your personal lender income will look weak. Not because you're broke, but because the paperwork tells a different story. So you need to have a way to prove the income you're stating. Depending on other factors that we will discuss later in this video, some lenders may even ask for supporting documents. If you're in lane A, these are more of a complimentary item, but if you're in lane B, I would strongly recommend you have these next documents ready to go. Your business bank statements, year-to-date statements, GST returns, invoices, contracts, business license, registration, everything that proves that you are legit. It's always better to over-prepare and have these documents ready than to be scrambling at the very last minute. Step 3, the silent killers. This is the stuff that most people ignore. Then they're confused as to why they got declined. But I promise if you follow these carefully, you're giving yourself a better chance. First silent killer is credit. If your credit is messy, lenders do not care that your business is booming. Before you start panicking though, I'm not talking about I missed one payment 3 years ago. I mean recent payments, collections, maxed all cards, lots of new debt, and high credit utilizations. Think of your credit score like a trust score. We all have that one friend whose trust score is so low that we don't even borrow them things anymore. You know what? Just keep it. I'm not borrowing it to you, just take it. And the mortgage underwriting process is literally the lender trying to decide, do we trust you with $400,000? Unfortunately for you though, they won't just say, just keep it. If your trust score is low, your credit score is low, and they don't trust you, they're just not going to risk it and say, no, we're not borrowing you any money. The second silent killer is your debt load. Car payments, credit cards, lines of credits, student loans. A lot of self-employed people use debt to float their business. Trust me, I get it. In 2021, when I was starting a marketing agency, I quite literally lived off my line of credit. But the amount of personal debt you have will highly affect your approval. So keep that in mind. The third and final silent killer is your down payment paper trail. You might have the down payment, but if it's all over the place, underwriters start asking questions. And when underwriters ask questions, it means delays. So if your down payment is coming from savings, a gift, sale of an asset, business funds, you need a clean paper trail. It's not all about do you have the money. Where the money is coming from is just as, if not even more important. Ideally, you should have your down payment sitting in a separate account for at least 90 days untouched to prove that this money is actually yours and also to show that you're not surviving off that money. Now that you understand those silent killers, let's move on to step number 4, calculating your self-employed income. Most self-employed people think lenders look at revenue. They don't. Depending on the lender and the program, they might use net income, salary, dividends, or even deposit-based approaches. If you made $150K in revenue, but after expenses, your net is $60K, a traditional lender will usually base your approval closer to that $60K amount. Here's the thing though, some lenders will look at that $60K net and then they will ask, are there any expenses that we can add back to this? This is where one-time expenses, amortization, depreciation, certain non-cash expenses, and sometimes even portions of your office or vehicle expenses could help. Not always, not guaranteed, but once again, this is why lender choice is so important. One lender could say, nope, net income only. Another says, okay, we'll consider add backs if your file is already pretty strong. And then the third could say, you know what? We'll use a whole totally different program that looks only at your business deposits. That way you can maximize your qualification. Same borrower, same business, different results. Just so you are aware, if you're incorporated and you pay yourself a salary, it's usually easier for lenders to read, and that's due to the fact that it shows up clearly on your personal taxes. Dividends are fine as well, but different lenders treat dividends differently. Some want a history of dividends, some want them to be consistent, some want to see corporate strength behind the dividends. If your dividends bounce up and then down and then up and then down, that could make some lenders nervous. The fifth step, which is the one most people usually just jump to, is the pre-approval. A real self-employed pre-approval has to be document-led. Not what do you think you're making, but instead show me what the paperwork proves, and then we build the strategy. When I do my pre-approvals, we first talk about your business, which is honestly my favorite part. I'm a huge fan and advocate of being self-employed, which is why I specialize in this area. So hearing all the different stories and ways people make money, it honestly never gets boring to me. We then talk about your goals for home ownership. Are you looking for the lowest monthly payment? Is this a 2 to 3 year home? A 5 to 10 year home? What type of home are you even looking for? Along with that, a lot of other questions to make sure I get you a mortgage that fits your needs and wants. Then we take a look at your income docs. We decide which lane you're in, which lane you want to be in, we check your debt situation, clear up any obvious red flags. After we've gone through that whole planning stage, only then can I give you a realistic pre-approval rate. If you get a pre-approval and they don't even ask about your self-employed documents, look, it doesn't have to be me, but look for a different mortgage associate. Once you're under contract on a house, you're stressed, you're rushing, your fiance is bothering you, you're emotional. The last thing you want is a pre-approval that was done the wrong way. Now here's the final step in this process, and this is where most people have their I get it now moment. Step 6 is matching the lender to your lane, not the other way around. Different lenders look at self-employed income differently. What you want is a lender that matches your goals, your business structure, your deduction situation, your credit, your down payment, all your strengths, and even your timeline. Everyone's situation is different. There is no one size fits all when it comes to mortgages. Let me put it this way. Let's say you're looking to buy running shoes. Would you go to a store that only has one supplier, one brand, that only caters to one type of runner? I will be the first to admit it. If you're in lane A, if your income on paper is strong, your credit is good, you've had 2 great years of solid tax returns, you should go to the bank if they're open. But if you're in lane B, if you have a great accountant who helps you with your write-offs, or you're incorporated and have income that is hidden, then I would highly suggest you speak to a mortgage associate like myself who has access to a ton of different lenders and a ton of different options. But the first thing you need to do if you're looking to buy a home in the next 12 months is click the link in the description and complete my 3-minute mortgage readiness quiz. Once you complete that quiz, I will personally record you a custom video within 24 hours breaking down your real numbers, explaining exactly how a lender would view your file, and laying out a clear approval strategy based on your timeline and your goals. Also, while you're down there, make sure to follow me on Instagram at @itsushindi for more self-employed mortgage advice. And if you have any questions, a link for that will be in the description as well.